Nvidia is up 2,700% in the past 5 years, while Intel is down 36%, and in this video, I am going to do an in-depth analysis of both companies to determine which one is the better investment. Starting with the financials, Nvidia has seen massive growth over the past 5 years, especially over the past year, with their revenue going from $10 billion in 2019 to $79 billion currently. On the other hand, Intel's revenue used to be $79 billion, but has seen a decrease to $55. Similarly, Nvidia's profit has increased massively over the past 5 years, net income going from $2 to $42 billion, and Intel's net income has fallen from 24 to 4 billion. This is because Intel has lost market share to Nvidia. They are reinvesting their profits to turn around, and this is what Intel CEO is thinking about the AI race.
And look, Pat, there was quite a long list of things that investors cheered, right? This is the third quarter where the markets basically said, Pat, we believe you on the turnaround story. But on your to-do list, where do you think you are and what do you think you have left to do on that turnaround story?
Yeah, thanks, Ed. And, overall, hey, it was a great, as we say, just a clean beat and raise on all the financial metrics. But even more important was the operational performance. And, as we said, hey, getting back to process leadership. And we, delivered key milestones. And we still have at least another year or two to go on getting that done. But major milestones, starting to deliver foundry customers. I promised one at the start of the year, and now we have 3 on our most advanced process technology, major packaging wins, and of course the product execution. Clean launch of the AI PC generation, but also the server business getting back to profitability ahead of schedule, and a little bit better performance there, and delivering the AI everywhere message with our accelerators, our server product line. So a really excellent quarter, and I'm just so grateful for the Intel team. It's been a journey, and we are clearly coming back.
Pat, you've talked to investors and indeed to Caroline and I about these new customers for the foundry business. When do we get names? When are you going to announce who these customers are?
Well, 2 things there, Ed. One is it's not generally the practice of the foundry industry for the foundry to be declaring their customer names. So one, it's not practice, and also many of the customers consider it confidential and part of their competitive advantage in how and what technologies they choose. So I can't promise names, but we're going to characterize them as best we can. And as we said, these are high performance and AI customers, and we've really seen the surge of interest in using the Intel technologies and foundry for different AI offerings in the marketplace. And that's both a wafer, but also a packaging. And this idea of advanced packaging, in addition to the 3 on the wafer side, we had 2 advanced packaging customers in AI, and that revenue materializes more rapidly, and 6 more in the pipeline. So overall, a really substantial quarter, and the AI space in particular has been the customers that have seen the most enthusiasm.
Let's talk about the AI space, because the running of AI models is where you see your future. It's not all just about the foundation models, it's actually the running of them, not just the building. But can you just relieve some of the anxiety coming from investors about a lack of clarity over data center future? And indeed, what is it that they need to hear from you? What more can you articulate that really makes it clear to them that you're going to be front and center in the AI race?
Yeah, thanks, Carolyn. And, really, first let's characterize what we're talking about, this idea of creating, these frontier or foundation models, as is described, versus using, right, and the training and the inferencing against those models. And I sort of compare it to like weather models. Not that many people generate weather models, but a lot of people use them. And that's how we think about this next phase of AI. How do we make this inferencing or the use of the models broadly available? And that's going to be, in the client, right? We talked about the AI PC. It's going to be at the edge, right, in retail and manufacturing and supply chains. But it's also going to be in on-premise data centers. And as we've said, instead of taking my data to the cloud, I want to bring the AI to my data center where the data is already. And finally, work in the cloud.
Analysts are expecting Intel to come back as they have them making $4.15 per share in 2027. If you assign a 20 PE to the company then, it would make it an $83 stock, meaning 170% upside. They are also expecting a revenue comeback as they have them making $76 billion in 2027. On the other hand, analysts are expecting Nvidia to make $200 billion in 2027 and $4.50 per share. If you assign a 35 PE to the company then, which is very high, it would make it a $157 stock, meaning 31% returns. Then, in order to calculate the intrinsic value of both companies, I use my Google spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. Starting with Nvidia, right now you're seeing 6 numbers. The top 3 are based on net income and the bottom 3 are based on free cash flow. They mean 2 things. First, that in order to make the desired annual return that I have put in, which is 12%, you need to pay these prices. Second, if the low assumptions occur, you are going to make a negative 6% annual return on your investment. If the middle occur, positive 8%, and if the high assumptions occur, 22%. On my middle assumptions, I have Nvidia with 25% annual revenue growth, 45% profit and free cash flow margin. I assigned a 25 PE and price to free cash flow to the company, and left the share outstanding change at 0%. Then, this is the Excel for Intel, and according to my low assumptions, you would make a 10% return, the middle 20%, and the high 29%. On my middle assumptions, I have the company growing at 7%, having an 18% profit and free cash flow margin, which is a bit less than what they were doing before this fall in profit. I assigned lower ratios, PE and price to free cash flow of 18 because Nvidia deserves a premium, in my opinion, and left the share outstanding change at 0%. Therefore, according to the spreadsheet, Intel would have better returns, but keep in mind that I assume they achieve the comeback. Moreover, the returns include the dividend. Currently, Intel pays a dividend that has a 1.6% yield and Nvidia a 0.03% yield. Moreover, Nvidia is trading at a PE of 76, a price to free cash flow of 81, and a price to sales of 40. On the other hand, Intel is trading at a PE of 30, a price to sales of 2.3, and the price to free cash flow is not available as it is currently negative because they are spending their money in a turnaround. Regarding the balance sheet, Nvidia has $31 billion in cash and only $10 in debt, which is nothing for a company that has a market cap of $2.9 trillion. On the other hand, Intel has $21 billion in cash, 52 in debt, and has a market cap of $130 billion. Therefore, it is clear that Nvidia has a much better balance sheet. In conclusion, Nvidia clearly has better fundamentals as they are growing more in every single category, and they have a better balance sheet. However, Intel is clearly cheaper and if they achieve the comeback, could have better returns. I think the questions we need to ask are whether Intel is going to achieve its comeback, whether Nvidia's growth is sustainable, and whether Nvidia is a bubble like Cisco was in the 2000 bubble. Remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know which stock you think is the better investment and I'll see you in the next one.